right. Welcome to Realtors Mastering Your Taxes in Q4 or ahead of 2025. We know that we all work really hard and want to maximize the money that we're spending and giving back, as well as taking all the advantages that we can. So I brought my friend Brandon Green in. Brandon and I go way back. I met him at a regional event, probably 2015 or 2016 at the Keller Williams Carolinas region, where he was a super master producer on a real estate team. And so I'll give that information here in just a minute. And he's just grown and grown to continue to build companies that help all of us realtors master being real estate agents. So a little bit about Brandon. He was born and raised in Iowa, and then in 1999 moved to Washington, D.C. with no money, no prospects, and no college degree. And look at you now, Brandon. Today, he is living the example of the American dream. He's been featured in the Wall Street Journal, the Washington Post, in Fortune and Inc. magazines. Brandon is an award-winning entrepreneur. He is part of or co-founder of the Keller Williams Capital Properties, ranking amongst the, get this, 0.2% of brokerages. And he is working to help entrepreneurs reach financial freedom quicker with more ease, which is why he launched Alchemy of Money. It's a financial services firm offering bookkeeping, tax, and CFO services to realtors across the country. So I know, Brandon, you have a lot more to add in that you're going to share with us today. So I'm going to turn it over to you to share all the things that I missed, the true ins and outs of Brandon Green, and kick it off with how we can take advantage here at the end of the year.
Great. Thank you, Debbie. I appreciate it. And hello for those that are joining us live and those that are watching the replay. I am excited to be here today and to talk about how, as agents and brokers and teams, we can maximize our hard-earned cash. I mean, it's no secret, it's tough business. And most of us get into the business because we're very giving people. And yet we don't often put our oxygen mask on. It's kind of the irony of it. Like, we're facilitating what is often the biggest financial transaction in someone's lives, and yet maybe we're not as attentive to our own financials as we could be, or maybe even should be. So that's what we're going to take a look at a little bit today, particularly from the tax side. So, taxes, right? But hey, maybe there's some opportunities. So I thought about, Debbie, how to construct a conversation around taxes, and I decided to take it from the perspective of the 5 expensive tax mistakes that I see people make. So 5 expensive tax mistakes that I see people make, and we'll kind of go from there. So Debbie mentioned that, I have been in the real estate business for a while, actually even longer, since 2001, and I started a team, and we were doing 20 million that first year, 30 million the second year, and by the third year, I had this thought that I was like, I think I need to file taxes. So I started in the business pretty far behind in the taxes. I ended up with like a $200,000 tax bill. And it was a real wake-up call for me to realize that you could be successful over here, but actually be failing pretty miserably over here. That I could be on the top of the production leaderboard and have great GCI, volume, and units, and even rental properties, but not actually be succeeding financially. And that was really a strange idea for me that led me down this road of self-discovery as a business owner, and now today owning a financial services firm, helping other people with their taxes and their finances. So let's get into it. I know we have limited time today. So number one for you to think about, Tyler, that you're live here, so we may be calling on you, Jeremy, Adam, Sarita, Pam, glad that you're here. So number one is, honestly, I think people underappreciate that taxes are only as good as the bookkeeping. So about 5 years into the business, after I got into the hole financially with the IRS, I got out of that hole, but then I got audited. And I remember getting a packet in the mail from the IRS, and it was a thick packet, which you generally don't want to get thick packets in the mail from the IRS. And it said I was under a multi-entity audit, multi-year multi-entity audit. Now, by then I had a bookkeeper and also CPA, so I felt nervous, but not freaked out. So I called my bookkeeper with all the stuff that I was supposed to gather for my CPA, and she said, "Yeah, Brandon, so like we need to talk." She goes, "You know all those emails I've been sending you for the last several months, even a couple years since we've been working together, with detailed spreadsheets and lots of bullet points and lots of questions?" And I thought to myself, "Yeah, I know those emails." She goes, "Yeah, the ones you never responded to." I was like, "Oh, right." She goes, we have a lot of holes in the books, and so this may not go as well as you think." I was like, and she was right. And I learned a very valuable lesson I just wanted to share with anybody today is taxes often are on our mind because it's so front and center. But the truth is, your taxes are only as good as the underlying books. The P&L and balance sheets need to be accurate. Now, you don't have to be obsessed about this, but there is an importance around bookkeeping. Nobody got into real estate that I've come up to yet that did so because of bookkeeping. Like, no, but it is a fundamental component of managing the business that must be handled at a relatively high level if you're going to succeed big picture around taxes or wealth building at large. So, number one sort of self check for you as you're listening to this is, are you getting a profit and loss statement every month? Are you getting a reconciled balance sheet? Would you even know if you were? When was the last time you actually reviewed it and asked questions about it? Is it up to date actually, or do you have like the side account that there's like a bunch of business stuff going in over there too, but it's not even over? Like, so what is that looking like? I am 100% certain that if your books are not at least an 85%, that if I were to look at them with my team, we would find that you're overpaying in taxes substantially. So look, the big deal here is you're just paying more in taxes than you should, and therefore not having the money that you could to invest by not nailing number one. So yeah, there's number one. Any comments or thoughts on that, Debbie? I know that you in your coaching you talk about P&Ls and balance sheets, and are you finding this?
Yeah, I think the key is because with coaching, we look at the P&Ls typically quarterly. They are supposed to look at them monthly with their accountants and that sort of thing. But
Yes.
oftentimes our accountants are a little behind, as you can imagine. And
Yes.
so getting them looking at them quarterly, as far as balance sheets, I think we tend to focus on the P&L versus the balance sheet. And
Okay.
so understanding a little bit more maybe on what is the
Yeah.
importance of that.
Oh, let me give you a little look at one of the categories in the balance sheet. So there is this area called owner pay and distributions on the balance sheet. So anytime you pay yourself as a business owner outside of a salary, it's booked in owner distribution or sometimes owner equity. When I launched Alchemy, I started to learn a lot of dirty secrets around accounting that I didn't realize were happening until I was actually managing the people doing it. And one of them is in the owner pay and distributions account, not only are they putting your owner pay, but they're putting anything in there that looks questionable. So we had a member come to us the other day who we were going through her stuff, and she had $30,000 in owner pay and distribution marked to Lululemon. Now, any reasonable person would say a Lululemon charge in the business bank account must have been personal. I mean, it's a lot of yoga pants, by the way.
It's a uniform for a real estate agent.
Well, there we go, Danny. So I was like, wait a minute. There are a variety of situations in real estate that maybe that is a business expense. So we called her up. We're like, hey, here's the deal. This is in owner pay and distributions. It's showing as a personal expense over here in the balance sheet. You can't see it in the P&L. It's in the balance sheet. What was that? And she goes, oh, well, we had a client event the other day, and we got these embroidery jackets for our best clients, and we gave them away at the client event. It had our logo on it. It would. I was like, oh, really? Well, that, my dear, is a business expense. It needs to come out of the balance sheet and onto the P&L. Oh, wait, that happened last year. Your taxes were already filed. So missed opportunity. All of that money could have been tax deductible, but because she wasn't paying attention to the balance sheet, she didn't even know there was a category called owner pay and distribution. She never looked at it. She went back and looked at it over the last 5 years, and guess how much money she came up with that was stuck there that had been filed on her taxes, water under the bridge. Almost
Wow.
$300,000 over the last 5 years was stuck in there.
Wow.
So yeah, the money's in the balance sheet, folks. So if you're like, wow, I've never even looked at my balance sheet, or I have never even looked at that category, I encourage you to do so. I can guarantee you there are actually business expenses in there that should have been booked as, or that are business expenses that were marked as personal that should have been marked as business. And if you pull that up, you can save some big money on your taxes.
That's
So
great information.
totally in the weeds, but a big one that people really underlook. All right, Brett, thanks for joining us. Good to see you. So let's go to number 2 here. Failing to execute a tax plan off tax season and failing to set up meetings with your CPA throughout the year. So you may be familiar with this one, right? Which is 2 days before the deadline or 2 weeks before the deadline, because you were a little tardy maybe in getting all the documents to your CPA. The CPA sends you your tax bill. It's like, okay, here's your tax return and you owe 30 grand, 40 grand, or 200 grand, or whatever it is. And you're like, wait a minute, let's go through this. Like, what are some other things I could have done? Wah, wah, way too late. First of all, the 2023 tax extension deadline just passed this last week. So if you were looking at that, you're like a year late because you can't do anything about it unless you're in the year that it actually occurred. And certainly you can't do anything about it if you're a CPA who's got a list a mile long of other clients to work with. You're gonna have a strategic conversation. It's never gonna happen. So the mistake people make is not doing the tax planning in the summer, or at the very least, latest now, between now and December 1. Because by December 1, that's like the deadline to implement great tax strategies, additional contributions to an IRA, shifting your entity type from a sole proprietorship LLC to an S Corp. Any of those kind of moves that could save you a ton of money in tax year 2024 have to be done mostly by December 1 of 2024. So the truth is most people are just way late. And part of it is because the industry is organized like a year and a half late. So as entrepreneurs, we have to drive the bus and say, let's set up proactive meetings. I recommend at least 2 meetings a year. Often people need 3 or 4 if you've got a lot going on and you've got really good income and maybe a portfolio. Those meetings would be a tax planning meeting, a mid-year meeting, a tax review meeting. Have you actually had a review of your tax return where the CPA walked you through all the line items? It's really powerful. You don't have to be a tax expert. You will see stuff that's missing because you're like, oh, well, I did such and such and I never told anybody about it. Let's get that on the tax return. Right? So number 2, a big mistake I see people just make is procrastination or not getting around, whatever, but just failing to execute planning and meetings throughout the year. Now, let me just say something about planning. Planning does not look like an email saying, hey, let me take a look at your tax returns and offer a couple ideas. That's not planning. Or I went to a class and here's 10 things I think I should do. That's not planning. Tax planning should be done in a written format with an extensive body of research on your situation and a review of all your documentation the last couple of years and recommendations of not only what do you qualify for to deploy, but when should you deploy it. So often great tax strategies should not be deployed in their entirety this year, but should be deployed over the course of several years. The idea around tax planning is to minimize the amount of tax you're paying over your lifetime, not just this next year. So all that really has to be done in a proactive way through scheduled meetings throughout the year.
Yeah, I have to share a little story. So I was speaking with Brandon this past weekend talking about, potentially him taking a look at my personal returns and my business returns. And as you all know, I've stayed in Holiday Inn. So I all of a sudden became an accountant, like, I don't know, 8 or 10 years ago, and do my own bookkeeping. And so we were talking, and he said, "So when was the last time you had a tax plan with your accountant?" And I said, "Well, I do all the bookkeepings. I just send him the stuff and he sends me what I owe." And he said, "Oh, you have one of those." So I couldn't even see him. I could feel him. And I'm like, "Oh my gosh, I just got scolded by my father." The Holiday Inn didn't offer a very good free breakfast. So it is. It's interesting as we as agents look at different pieces and learn in different classes on things we can write off or what could be considered business expenses, put your label on it if it's marketing and don't call it a gift, all the things. There's so many additional pieces that could be addressed throughout the year. And like one thing for me was, should I buy a car? Should we be buying an additional investment property? Should we be moving money into some type of account?
Yes.
I don't ask my accountant those. I just wait and say, "Is there anything I should do based on what you see in QuickBooks?" And he's like, "Nope, looks great."
Yeah, I mean, well, the truth is most people don't need tax planning. Most people don't. And most of the industry is not organized around it. It's a compliance exercise for 99% of the people in the world. I need to report my income to the IRS. I need to report expenses as a good citizen of this country. That's most of it. But for entrepreneurs who are making more than a couple $100,000 a year, who have more than one business, who have a portfolio of rental properties or other assets, you can go to tax planning. Well, you don't have to. I mean, the IRS is very happy to take your maximum contribution every year. They have no problem with that at all. So you don't have to, but you just start to lose a lot of great opportunities as you move up that ladder in wealth and realize the entire tax code is organized for wealthier and wealthier people, but it's very complex and it has to be mapped out with professionals. All right, number 3. This one's interesting, and we talked a little bit about this, Debbie. Number 3 is not executing not executing cost segregation on a rental portfolio. So cost segregation, for those that don't know, is when instead of depreciating the asset over 30 years, you perform a study that looks at all the pieces and parts of the rental property, and each one is depreciated on a different schedule, and it has the effect of speeding up the tax deductions and pulling more tax deductions into the present time. There's usually 2 issues with this. One is a lot of CPAs think this is only for large commercial properties because a cost segregation study is $10,000. The truth, though, is this is also for residential properties, and a cost segregation study for a residential property is not $10,000. It's probably closer to something around 2. So you need to probably have a rental property that's not a $50,000 piece of land in random place country. Like that's probably not cost segregation worthy, but a lot of residential is. The other issue, though, is you have to think about whether or not you want to deploy the results all in 1 year or multiple years. Because if you take all of the results in 1 year, then you don't have any more or don't have much more tax deduction in the future. So the IRS is the classic, you either get this or you get that, you don't get both. So in cost segregation, the IRS is like, you can take all the deductions now, but you don't get any more in the future. Or you can spread them out over the next 5 years, but then there's a cliff and you don't have any more. So you can imagine then whether to deploy cost segregation as a tax strategy is dependent on how long you're going to keep the asset. Because if you're going to keep the asset for years and years and years and years and years, you may want those tax benefits 10, 15 years from now. Versus if you're like, no, I'm going to probably sell this asset in 5, 7, or 10 years, then you do want to take all those tax deductions now. So it's a great strategy for residential portfolios in addition to commercial. And it is underappreciated, and a lot of CPAs who are not real estate professional CPAs don't understand how it works. So if you own any rental properties, this is certainly something to look at in helping your tax planning. Taking a drink, offering any questions if anybody has any.
Questions?
Okay.
I have to add, I didn't realize that I could do that with residential.
Yeah.
And I have a rental portfolio, so that especially when you talk about selling it short term versus holding it long term.
Yes.
Because we do purchase some that we anticipate will be a short term investment, even if it's a rental for a period of time.
And I mean, there's so many things you can do with rental portfolios. If you're in the real estate business and you're in the real estate business full time, you probably qualify for the real estate professional tax status, which is very powerful tax status. Now, interestingly, from a tax perspective, the real estate professional status has nothing to do with your license status. It has to do with how and how much time you're spending in the business. But if you're a real estate professional, you can deduct all of the losses that you have in the year in which you have them and offset your active income, your commission income or something else. If you're not a real estate professional and you're a W-2 employee of a, company somewhere, you have to take those losses mostly when you sell. So it is extremely powerful to know whether or not you're filing as a real estate professional on your tax return. And if you are in the real estate business and you're not filing as a real estate professional, I would ask why, and take a look at that very carefully. So I'll give you one example in my life. I uh, put a bunch of money into a project to try to change the zoning, and I failed miserably. It was a tough process, and I lost $503,672. I know that because I just wrote it off on my 2023 taxes in its entirety as a lost intangible asset. All the attorney's fees, all the drawings and renderings, all of the community meetings, all that we did for almost 2 to 3 years cost me $500,000, and we failed in that project. And because I'm a real estate professional, I'm able to deduct all of that in calendar year 2023. So I've got a loss carry forward on my tax returns. I talked to my husband. I'm like, hey, good news. We won't be paying taxes for a while. I'm like, he's like, yeah, that's not really good news because that means we lost all that money. I'm like, oh yeah, nobody knows. Good news. We won't be.
Finding the silver lining. That's what I always say. Just find the silver lining.
Let's make some lemonade. Let's make some lemonade. But it is really powerful. Anytime you're starting to deal with real estate, cost segregation, or other things, you've got some big opportunities you need to look at. But they are complicated and they need to be mapped out. All right, extra credit here is one of the best ways to save on taxes to actually pay the amount you owe on time and not wait for a big bill. And they're due for entrepreneurs April 15th, June 17th, September 16th, and July 5th or January 15th in the year in which they occur. So any tax liability you owe now is due January 15th for the year 2024. A lot of people haven't been paying on this schedule and it wasn't so noticeable, but the thing is as interest rates have gone up, the interest rate that the IRS charges you for not paying your taxes on time has also gone up. So a lot of people have been very surprised this year to see the penalties and interest portion of their tax return. They didn't notice it in previous years because the interest rate was negligible because it's tied to the 10-year treasury rate, and that rate was like 0 for a long time. Well, now that rate is like 4, and the IRS adds another 3 and compounds it daily. So it is now very expensive not to reconcile your tax liability quarterly if you're making a good profit every quarter. Because if you're making a good profit every quarter, you owe taxes every quarter, and if you don't pay it, the IRS is like the worst loan shark ever. And you will lose a lot of money because you're not paying it on time. So just note that, like simple administration here, but put these dates in your calendar, or you could be under or overpaying maybe the IRS lots of money if you're using last year's coupon from your CPA to pay your taxes. Like, who on this call has had a year over year, like 2024 was exactly the same as 2023? Like, unlikely, right? So this is sort of an easy one.
So are you recommending the outside of the coupon, the calculation of taking, let's say the coupon was based on 2023 and I've only by now we'll call it, today is September 15th. By September 15th, I've only made 85% of what I made by September 15th of last year, then pay the
Yes.
equivalent of that 85%.
Yes, that's correct. And ideally,
Okay.
you're in relationship with your CPA and they can update those numbers for you once or twice a year. So you're paying the tax you owe in the year in which you owe it, and therefore not paying penalties and interest versus waiting until next year when they complete your tax return and then say, well, you should have last year paid more than you did, and here is a penalty and interest on that for not paying it when you were supposed to. So it can be thousands of dollars. But I think this is going to be probably bigger next year as we hope the market turns up and people make more money next year than they made this year. There's not a lot of people that I know of that have made more money this year than they made last year, but a few have. And if that is you, then you definitely need to look at your tax liability. If you're paying your taxes based on 2023's coupon in 2024 with a much better 2024 or a much worse 2024, I should say, right? Update those numbers, stay on top of it, and have your CPA true that up. It's one of the big things that we do at Alchemy for our tax members is we're like, forget about last year's coupon. What have you done this year? And let's take a look at what your tax liability is up or down based on this year's performance.
Great tip. Great tip.
All right, tax savings checklist, some write-offs or more. Number 4 is mismanaging write-offs. So I already gave you one example of stuff hidden in owner distribution, but another big area is this whole entertaining business meals thing. So for a while during COVID, we went from business meals with the client from being 50% deductible to being 100% deductible. This was a COVID bill that said if you go to a restaurant with a client, you can deduct the whole thing. That only lasted a couple of years. We're back to 50% deductibility. So whether you take one person to lunch or 10 people to lunch, it's only 50% deductible. And interestingly, anything in your books marked entertainment is 0% deductible. So if you've got a category in your books called entertainment, I might ask you what you're up to there, right? Because it can really not be deductible at all. Versus, an event. You could literally make an argument that you were having an event, not a business meal, or you were having an event, not entertainment. And now, look, you got to justify this to the IRS if you ever got audited. Sometimes the naming of expenses in your books makes all the difference between you getting 0% deductibility, 50% deductibility, or 100% deductibility. And I say pay very close attention to meals, gifts, and entertainment, because those are like default categories in a lot of QuickBooks files. Accountants are like, you went to insert name of restaurant. Well, that was probably a business meal. Meanwhile, that was actually an open house that you had where you catered food into the open house from that restaurant. So the accountant's like, oh, it's 50% deductible at best. You're like, no, that was an event. It was an open house and I brought in food. Oh, that's 100% deductible. So meals, gifts, and entertainment, now's the time to look at that and see what do you have booked there, because by you changing some of the names around a little bit, you could really optimize your tax deduction. And look, you got to, with a straight face, be able to defend that in an audit, right? So you gotta figure out where your judgment is on that. But I would argue all day long, a lot of what we do, you could certainly classify it as events, given the unique nature of the real estate business. Questions on deductions. I know sometimes you're like, oh, can I deduct this or can I deduct that? For those that are live, you have the privilege of asking any questions if you want. So if you have any questions, you can even put them in chat. Well, I've got you here. I'll try to clear those about deductions. All right, doesn't look like it, although Tyler looked like he had a really good question, but maybe not. All right, let's go into some other strategies, folks, for you to look at. One is whether and when you should be an S corp. S corps are fabulous for active businesses making more than $250,000 a year. So it could be a real estate practice, it could be property management, it could be a flipping business. If you're making more than a couple $100,000 a year, you should talk to a CPA about whether you should be an S corporation or not. If you're making less, it may not be. Like, when you go to an S corp, you make a deal with the IRS. And it's important to know what the deal is, because like anything in life, there's up and down. Like the pro and an S corp is the IRS is like, you're a corporation. We're going to give you more tax breaks because we give corporations tax breaks. That's nice. But then the IRS is, but we need some things from you. First, we need a separate tax return. You can't put all this stuff on your personal tax return anymore. Second, you actually have to have a set of books. You can't be like Excel spreadsheet wizard. Like, no, you need a set of books, a balance sheet in particular. 3, you have to put yourself on payroll. So you have to have a salary, which means you need to have enough consistent cash flow in the business to pay yourself a salary. Because if you turn it on and turn it off and turn it on and turn it off, they're not going to be happy with you, and you're going to get a lot of notices from the state and federal government with unreconciled payroll accounts. Nightmare. So you've got to have enough cash flow to handle that. And then finally, the IRS says you got to keep it for 5 years. So you can't like be in and out of it. You got to be confident in the business. If you meet that criteria, it can be majorly beneficial for you from a tax perspective. Oh, and a bonus, do not own real estate in an S corporation. You can flip real estate, but do not own it. You will be very unhappy with your tax bill when you go to sell an asset that was acquired in an S corporation. Other strategies that are good around vehicles, home office deductions, rental properties as a lever, the Augusta rule. Right, I love this one. Somebody had the eye of some lawmaker who was clearly a golfer, because this comes from the tournament in Georgia where they're like, we got all these nice properties around the golf course. We want to rent these out. We want to get a tax deduction. I don't know who got that through, but somebody got that through. And it benefits all of us. We can essentially rent our primary residence back to ourselves for a couple of weeks and get a really good tax benefit. Now, there is some administration you have to do to actually comply with the provisions of the Augusta rule. So you can't just say, I'm going to do the Augusta rule like a magic wand. Like, you actually have to do some things, but it's a really nice tool for a lot of people, the Augusta rule. And then qualified retirement plans. This is like IRAs and 401ks, great vehicle to reduce your taxes. I say it's a balancing act because you have to have the cash to put in there. So it's not a freebie. Like, the IRS essentially says you can either put 10 grand into your IRA or you can give us the 10 grand. But the 10 grand has to be moved out. So if the 10 grand doesn't go away, the 10 grand is owed to the IRS, or you can put it in your retirement account, but you must take the 10 grand out of your checking account and put it somewhere. So some people are like, oh, I get this freebie. I don't have, no. Nothing's free. But by giving it to your IRA, you're giving it to yourself versus the IRS. I mean, that seems like a good deal. But anyway, but there is a balancing act. You have to have the cash to deploy the strategy. And almost all tax strategies require cash. So you don't get the strategy with no cash. You have to have the cash to deploy the strategy.
Can I ask about vehicles? I know this is one of the questions I get often on requirements, and I know it's forever changing. So can I buy one each year and sell them and get the full deduction? Do I have to put it in the name of my S corp, or can I put it in my personal name? What are the requirements for the vehicle to be tax deductible? Would you mind expanding on some of that?
The easiest way to think about vehicles for real estate professionals is you have to track your mileage no matter how you're doing it. And you're only going to get a portion of the vehicle deducted based on the mileage you drive from a business standpoint. So you can't get out of it. You have to use Mile IQ or some sort of app. So whether you buy and sell the vehicle quickly or slowly, whether the vehicle is owned in your name or in the business, it's really irrelevant, because even if it's owned in your name, you still get the tax deduction. If it's owned in your business, you still get the tax deduction, but not any more than if it was owned in your personal name. It's all about tracking mileage. Now, there are a couple little exclusions to that. One is if you own a fleet of vehicles that you dedicate to your business, that's different. But the IRS pretty much says no real estate agent has a fleet of vehicles. We're talking about your local plumber or electrician with a branded van, like where they come into the lot at night and they park the vehicle and then take their personal vehicle home. Like, that's a fleet of vehicles, and it has a different set of rules than business owners that use a vehicle either mostly all for business or even all for business. But in real estate, you've got to track your mileage on that. So don't worry about owning it personally or in the business. Most people own it personally because you get a better loan if you own it personally. Your tax, in most cases, license fees and so forth, are lower if you own it personally, and you can still get the full deduction on your taxes.
Great. And the one addition to the fleet, and we're seeing this more, is in the property management space where they
Okay.
are creating segmented or compartmentalized departments for their maintenance and that sort of thing. So I have seen a little more of that recently where they're purchasing 3, 4 cars so their maintenance and their leasing agents can go and utilize those cars and they get the advantage of the tax break.
Yeah, so there's some interesting rules around what makes a fleet. I don't know them fully, but it has a lot to do with whether or not you have employees and the employees are using the fleet, and that the employees actually drive their personal vehicle to a location, take the business vehicle for business, return the business vehicle to the parking lot, and take their personal vehicle home. So you have to be able to demonstrate some of those if you were to be audited, right? You'd have to demonstrate some of those operational details to be classified as a fleet.
Very good. All right. Any other questions? All right. Take it away.
Okay. All right, so I just have like a basket of things to roll through here. I'm not going to stop on any of them, but just as a visual, this would be sort of a gut check. Like, do you even know what this stuff is? Like, as an entrepreneur, you don't need to be a tax expert, but I want you to be relatively well informed and more informed every year. So if you're like, look, I don't know, I don't even know if I have or should have a 401k or an IRA or a defined benefit plan, great. That's an area for you to look at with a financial planner. You know, if you've never heard of the kitty tax on unearned tax on unearned income, if you have kids, like paying your kids a salary and getting a tax benefit for you and for them is a thing. Like if you've never heard of that, that's something to look at, right? Yeah, I don't know. Some of these are super obscure, but some of them are more important than others. You know, it's kind of kind of good to know what like failure to pay penalties are. Hopefully, you don't get there. Gift tax exclusion, like some of this stuff may or may not apply. There's dozens and dozens of them, but just sort of understand them. You
Can
know,
I stop you on the gift tax? Because that's something we see as
yeah.
real estate agents. We're seeing more of the generation of the boomers gifting money to their children to purchase homes because the prices have gone up so much. Do you see that as are there limits, I guess, on that
Yeah. Up
before they
to
get taxed?
in 2024, it's $18,000.
Okay,
So you can give up to $18,000 before you have a potential tax liability.
okay.
Yeah.
Thank you.
And I say potential because everything in tax land is contextualized to the individual. But generally, 18 grand is the limit.
Okay.
All right, number 5 is, paranoia about audits. Interestingly, there are some things you can do to reduce your audit risk. One is you can go to a S corporation instead of putting all of your business income and expenses on your personal return Schedule C. The percentage of people who are audited with an S corporation is far lower than a Schedule C. I don't know for sure why, but I think it's, the IRS is like, look, if you're an S corp, then all these other compliance things kick in. And you have to do all these things, and we're watching for all those things. And therefore, the chance of shenanigans is lower in theory. I don't know if it's true or not, but versus Schedule C, like we're guessing, you don't know much about accounting, you don't spend much time or resources on accounting, and therefore there's things that you're not doing right. Again, I don't know if that's accurate or not, but I think part of the thinking on audits is they're less likely to audit people who appear to be more sophisticated. Let me give you one interesting canary in the coal mine. So I started with telling you about my audit. So I did not do so well in that audit because I had deducted a lot of travel expenses with no underlying documentation. I didn't know what I was doing, and I was frankly very interested in pushing the envelope significantly. And well, that didn't work out so well for me, but I did ask an important question that I was probably being somewhat of a smart aleck at that point because I was just annoyed that I was in that situation. But now, many years later, this question has turned out to be very valuable. Yeah, and that was, I said, when it comes to real estate agents and audits, what's the number one thing you look for? And the auditor was like, oh, well, it's this one thing, and we all look at it all the time. And if this thing is in order, chances are good that everything else is in order, and we have far fewer questions. I'm like sitting on the edge of my seat. I'm like, what is that thing? Like, what is that one thing? She goes, a mileage log. She's like, real estate professionals who have a mileage log are far more compliant and organized with their taxes than those that don't. Oh, and by the way, we can tell if you just created it for the audit, which is what I had done. So I was like, that's really interesting. So there are some things you can do to reduce your chances of an audit, but more practically, the things you can do to make a more successful audit, should you eventually get one, which is really just a matter of time if you're successful in business, is to have really good financial records, one of which is a mileage log. So I thought I would share with you that little tip that came about 20 years ago now that is still relevant today as we now interact through Alchemy with the IRS all the time. And we see all the time the fact that they have very few questions to start. And if you can answer those questions successfully to start, they don't have any more questions. If you cannot answer those questions successfully at the start, they have lots more questions. So another good reason to have good, solid, tight books, keep track of your records. Don't be paranoid, be prepared, and start now. That's number 5.
All right, I'll download the app on the way home.
Yes, exactly. So if we can help you, of course, please, we'd love to. Alchemyofmoney.co is our website, alchemyofmoney.co. We would be very pleased to help you out, either get things a little bit more organized or get you out of a pickle if you're in one.
Yeah. And I love the proactive approach. And that's the key is, like I said, I tend to end up doing it on my own and then getting to the end and hoping and praying that I did all the things I was supposed to. And so,
Yeah.
um,
Yeah.
yeah, I'm
And,
looking
and
forward to
look,
it.
some people do a great job on their own. So it may not be about the fact that it's good or not good. It just might be, at some point in your life, it might just be time for you to do other things on the weekend other than your books, right? So I have definitely seen some people do a great job with their own bookkeeping. No, you don't have to hire a professional, but there usually is a point at which either you do because they get too complex, or you wish to because you have other things in your life that you want to do.